Good morning. Happy Monday, everybody. Welcome to Charts and Coffee. We are kicking off today with a reminder that it is end of quarter. End of quarter is a tricky thing. We've got intense rotation, potentially in a very select number of sectors. We are now basically a month out from elections. There's one thing that's really interesting about September, and it drives this home really clearly, is that seasonals are not setups. I mean, if we were all looking at the same seasonals charts, I think we all were, we know that September tends to be extremely bearish, right? And what happened? In fact, S&P hit all-time highs again in 2024. So what a great lesson that seasonals are not setups. Just because a specific month might have, over the course of the previous 5 or 10 or 25 years, have been bearish or bullish for that matter, doesn't mean it will be, because we are trading the now. We are trading the data we're getting now. We're trading the market, the monetary policy, the markets, the S&P, the NAS, treasuries, currencies are dealing with now. And ultimately, it's never the thing that we expect that moves the market in a specific way, that moves stocks in a specific way, or treasuries or metals or energies. Probably the most interesting that's happened over summer was that yen crisis, after which the uptrend continued. And we hit all-time highs again. This has been a really good year for account growth. It doesn't mean, though, that you've missed everything. It doesn't mean that there's no longer opportunity. Ultimately, what we want to remember is that as we're looking at the last quarter of the year, we are still in an overall uptrend, or at least a bullish environment. The uptrends have been a little wobbly since the end of July, but we're still in an overall bullish environment. So the best way to start your day is to start it with a watch list. And that watch list should predominantly be those symbols that are following the overall trend. And then after that, we go through our regular process, all the things we do to grow accounts, all the things we do to manage risk, all the things we do to position size. They are different things. The same thing that I focus on to manage risk is not necessarily, although it's an ingredient of the process that I grow an account with. So ultimately, if I want to look for follow through, is it the NASDAQ at the moment that I want to look at? Or would it be some of the outperforming individual sectors that seem to be coming on? Or might it be an individual stock that looks better than the NASDAQ, or even the sector that it's in? And if you've been following this show for any amount of time, you know I mentioned that what you trade is far more important than just about anything else. Because if we can find the symbols that have the probability for follow through, look, fills get us in, but follow through pays. And that's what we need. And that's what we're always looking for. Now get that list right, dial it in. And now we start applying the formula of risk management. Now we start applying the formula of position sizing. And then ultimately that formula for, okay, are these the kind of trades that will grow my account? Or is this the kind of symbol that's just going to sit and go nowhere? And those are the kinds of things we think about. And these are the kind of things that I've been getting a lot of questions about. Folks are struggling. I'm seeing people not growing accounts through 2024. And it's really heartbreaking, because this has been a very, very good year for that. Even with some of the surprises we've seen in April and in August, the general gist has been higher. All right. So, of course, if you haven't already received an email, or if you do not know, on Wednesday, on the 2nd, I know tomorrow's October 1st already, on the 2nd at 8 p.m., we're going to get into some more topics along the lines of what we talked about last week. So this is not a rehash of last week's webinar. We're going to dive into how to grow a small account with more detail. Talking about SPX, we had a couple examples of what I've been testing for the past 6 months in SPX for specifically smaller accounts. Now, if you don't have a small account, if you have a medium or large or Godzilla-sized account, the same process works. There are, however, challenges that a small account has. And would you believe most traders, most retail traders actually have what I would define as a small account. And I don't mean $1,000 account. I mean, I'll be straight up. If you've only got $1,000, don't trade. Use that for education, grow the sum. But there are certain things that qualify a small account, and there are certain things you can do to grow it, right? So we're going to get into all this on the second, but this is where we sit right now. Now, if you're curious, okay, Rod, what about the sector rotation? You did allude to it. Where are we with that? And right now, and by the way, if you're a Sector Secrets Mastery member, check out the premium videos as part of your mastery. Check out the newsletter that's coming out today, and you'll see what we're focused on. But for the most part, it's really interesting to see that the surge that is most visible, the sector rotation surge that is most visible as we're wrapping up the month, is actually in metals and mining. Credit to copper for getting going, and semiconductors. I would keep an eye on those. Now we have some symbols that have been strong and continue to be strong. Basic materials has been lingering in the strength side. Consumer discretionary has been the absolute, up until now, strongest sector within the NASDAQ. Now semiconductors have kept pace. Telecommunications have been up there. Industrials have been up there. Utilities have been up there. But there's some things that are slipping that were very, very strong in September. Staples, gold miners, financials, healthcare. This is what I mean. So if we're still living in the past performance, if we're still living in the movement that we saw a week or two or three ago and not adapting to the end of quarter, we're going to be in big trouble. And that's what I mean about keeping an eye on what you're trading and your expectations around that, because that's sometimes, unfortunately, the least discussed aspect of account growth, oddly enough. What we trade is a huge part of account growth, right? And if we're looking at symbols that are sideways or down and we're looking for great bullish follow through, we're going to be really, really frustrated, even if we apply great stop losses and risk management. Even if we really dial in the position sizing, doing the right thing for the wrong symbol is just not going to get us anywhere. So again, that formula for account growth is a number of things that we do right in a slightly more ambitious way, right? And those are things that once we dial in, again, they can be applied to any sized account. All right, so I see some questions coming through. Good morning, good morning. As far as Newmont mining, all right. Now, many of you in the mastery will notice we were very active, we're more active in the earlier part of the month. We started to wind it down towards the end of the month. And that is by design, because that's respecting the calendar. So there are a number of things that are absolutely, Gwen, on my radar, 100%. There are a number of things on the radar. But this is where that patience around the end of month and the end of quarter, both are happening this month. That's where the patience around that triple witching, and we had that this month as well. And I'm going to be more discerning about setups. Do I like Newmont mining? Absolutely. Absolutely. I do like Newmont mining, and it's something that I would want to try to set up and buy. Would it be a mean reversion? Will it be a daily price movement range zone? When we take a look at the markets together in the mastery, we'll take a look. But yes, this is the beginning of a swing trade that I would start to look at, getting long calls in off the daily price movement range. So that's definitely something. Yeah, absolutely, Gwen. It's on the radar for sure. In fact, I've got the weekly watch list this week, and I'll actually give you all a quick little sneak peek of what I'm going to be talking about. So if you're a member of any of the simpler services, you will get access to this. Of course, these are topics that we'll dive into more deeply in the mastery. But these are the kind of things I'm looking at. And Gwen, you'll see there, gold and gold miners, NEM is definitely part of that narrative. Do I ever trade the German DAX futures? Paulie, no. Sometimes, and I mean rarely, I will look at the EWG. But I typically don't do a lot with those European markets, whether that be even UK FTSE or CAC 40 or DAX. I typically don't. It's not that there's anything wrong with it. If you've got a really good beat on the, in other words, if you've got a really good read on those monetary policy, that rhythm, in other words, what is the European Central Bank doing? Just like what is the Federal Open Market Committee doing? Then you probably got a really good shot at looking at foreign, from here, foreign stock markets. But then I would also say one thing I'll more likely do before I even trade DAX is I'll get a read on the euro. So if I'm looking at euro, I'm probably looking at DAX. If I'm looking at pound sterling, I'm probably looking at the FTSE or the EWU as well. All right. Next up is, let's see what else we've got. And by the way, if you did not see the link for the webinar on Wednesday, I'm going to share with you all some of the results from the last couple of months and, what's been going on with the September equity curve. How are we trading? I'm not picking out a bunch of well-chosen examples, gang. We're going to talk about everything we've been doing. In fact, I started off this month, which has been a very good month, in the negative for about the first week. But that's where the risk management part of the formula saved me, and the position sizing. And then as the trend started to reemerge and follow through, as I started to dial in the watch list, the account growth portion certainly happened. And we'll talk more about that. All right. Let's see. Daryl asks, is there a sector that historically performs well at the end of quarter? No, we always want to look at, and I'm sorry, you answered my question. Yeah, there's not a template. I get this question a lot, gang, which is, Rag, if the Federal Reserve cuts, what are the sectors that benefit most? Rag, there's no template in trading, gang. There's no template. There's no saying when this happens, this will always happen when it comes to watch list selection. What watch list selection for account growth is really about. Really simple. And it's probably the most basic thing. And then on top of that, we build a lot of nuance, but find things that are moving higher. There is always something. If there's fear, staples are going to benefit usually. Utilities are usually going to benefit if there's fear or risk aversion. So I would look there. Don't guarantee there'll be an uptrend, but I'll look there. So there's never a time that the money's going under the mattress, right? There's never a time that everyone's off the field and sitting on the bench. Something somewhere is going to look appealing depending on the current environment or the monetary policy or whatever might be out there in terms of risk appetite and expectation for higher highs and greed in the most basic sense, and risk aversion, fear, and traders taking a little bit more of a cautious approach. Something's always going to benefit, right? Whatever the narrative is, when something's going down, something else is going to benefit. Are they always the same two things? No. But if we know that's the way money and attention flow, we know that weakness somewhere is actually going to start to lead to strength somewhere else. The cool thing about strength is you don't always need something else to be weak. Lots of things can move up together, which is one of the many, many reasons I tell most traders, if you're focusing on account growth, focus on the bullish side. And really, without mincing any words, the Bears, how are the Bears doing? Caleb Williams, I was watching the Hard Knocks on HBO. I'm passing on football season. That's been a controversial thing in the match. I said, hey, you know what? I'm gonna see what I can do if I can reclaim 12 to 16 hours of football watching and do something else. And anyway, I was watching the HBO Hard Knocks because that's kind of cool, that behind the scenes stuff. But aside from the Chicago Bears, the Bears in the market this year have been so consistently wrong because they don't want to look at what is. They want to find a narrative and then superimpose that over price. The Fed can't do a soft landing. That's not a setup, right? The yen carry is the new crash. That's not a setup, right? In fact, the entire year has been in what I like to call the bullish hemisphere, which is above those white dots. And overall, the year has been dominated by green candles. These aren't just green, generic Japanese candlesticks. These are green candles that measure both participation and trend. We've spent most of the year in bullish trend and bullish momentum with some periods of neutral, but mostly up, and then very, very few periods of a downtrend. And these are all the tools that I'll show you in the webinar on Wednesday, because this is what I use to understand what I'm seeing. And I can then shut off a lot of the narrative, which is not necessarily based on data. There were folks coming into September that thought the Fed's not going to cut rates. We're at all-time highs. That is such clueless talk. I can't even begin That's talking what I think, not talking what I see. The data has been clearly saying not only is the Federal Reserve going to cut 25 basis points, it was a very high probability that they were going to cut 50. And that's exactly what happened if you look at the data. And those are things that I think a lot of traders struggle with. They get stuck on a narrative that's not backed by what price action's doing. Now, I will say the NASDAQ's been definitely a laggard. The Russell's also been a laggard. So be a little bit more cautious there. Regional banks are not benefiting from rotation at the moment. It looked briefly like they might, but as we're winding down the month, it looks pretty disappointing for folks who are expecting an explosion higher in the regional banks. And when you start understanding some very basic connective threads of watch list building, like we do for account growth, you'll realize KRE isn't going anywhere. Likely, the Russell is not either. So these are little things that when you understand the connective threads, you realize, oh, okay, this is connected to that. And if they're not in uptrends, I'll seek another symbol to trade. All right. So let's see. When I'm looking for a 5 to 7 day swing trade, I don't look at trades like that. 5 to 7 is not one of my windows, but I'll be specific to the windows that I look at. Short-term swing trades usually last 1 to 3 days, but I'm not locking it into that. I just have realized anecdotally, and actually based on data as well, that shorter-term 1 hour swings tend to last for 1 to 3 days, while my daily time frame setups tend to last from 2 to 10 up to about 3 weeks. And those are typically about the windows. Now, I don't trade for a specific amount of days. I just know how much overnight exposure I might have to deal with. And of course, overnight exposure is always a challenge. So let me just tackle the second part of your question there. Does the daily opening bell and closing bell volatility have an impact on how I manage the trade? No, it's price. It's understanding the risk for the trade at the moment that we get in. There are some things that I do teach, and it's an interesting question you ask for sure. Are there certain times of the day where it makes sense to just let price action happen without managing risk in that window? I know it's a crazy one. Yes. Typically the first 30 minutes of the day, I'll be a little bit more patient about a trade that may be moving against me. The last part of the day, the last usually 10 to 20 minutes can be very volatile as well. So there are certain rhythms of the day that I will be a little bit more observant of, because what's happening, for example, in the first 30 minutes of the day does not necessarily foreshadow what I'm going to be seeing the remainder of the day. So there are times, even for swings, that I'll say, look, let's wait to manage after this point in time. But really the overall principle is, what am I trading? How many contracts of it am I trading? How much risk is there per contract? And how much risk does that present to my account, right? I look at those 4 things. So that's the foundation of risk management. On top of that foundation, we start building the account growth side of things. And that's really pretty difficult for a lot of traders who haven't really been trained on something like that. So those are things we want to definitely keep in mind. All right, so we're looking for symbols with the highest probability, right? We talked about continuation for follow through, right? We use this holy grail basis as a foundation for deciding how much should be risked and therefore how many contracts we can trade, right? The holy grail is the starting point, right? I think a lot of folks say, Rag, is account growth the holy grail? Is it just risk management? Oh gosh, no, right? Because the holy grail is the starting point, allows traders to say, oh, this is how many contracts I should trade and what to do if the trade goes the other way, how to set those targets. And then it answers that all-encompassing question is, why isn't my account growing? All right, that's another answer. This is where we're going to talk about on Wednesday and on the class on Saturday. This is where the class goes a whole lot further, right? So we'll definitely start that conversation on Wednesday. So if you have a deep, deep understanding of risk management, where these numbers and formulas are coming from, then you can start to customize, right? This is the cool part. Then you can start to customize your trading style and you understand your risk management specific to your account. Because as we like to say, risk management isn't a ball cap. It's not one size fits all. So when we're talking about all those nuances, the question about what times of day might I be a little bit more aware of risk, that's already been built into the initial stages of the trade where I already know this is what I paid and this is what I'm going to risk. And if all things go poorly, this is how much it's going to cost me. And you sleep better at night when you know the worst case scenario. All right, gang, as always, thank you so much for being here for Charts and Coffee. I'll see you tomorrow, same time, same station. And if you haven't already registered, simplertrading.com/reliable this Wednesday, 8 p.m. Okay, gang, be good to each other.